What's up, everybody? Eric here. Welcome back to All the Outliers. And we are here with the Outlier podcast. And I have David Hunter back on. I think this is probably like your seventh or eighth time with us. We kind of catch up every quarter, which serves as a really interesting way to follow along your view of markets, how things are playing out, and then to receive new information as you're seeing it. So, first off, welcome back. Great to have you.
Yeah, thanks, Eric. Good to see you. Merry Christmas or happy Hanukkah, whatever.
Yeah, we're getting there. I was saying right before we started, you already got the red sweater on, so you're quite festive, which I can appreciate. Like I was just telling you, my wife, she started decorating for Christmas 2 weeks ago, so it's all a blur to me at this point. But man, what a year. So I have a lot of things that I want to talk to you about. The very first one is the last time we connected, for everybody's context, you and I had spoke sometime like mid to late August. It was like right around there. And at that point, you felt the market was at kind of a decision point. We started to pull back. Speaking of the S&P 500 here, we started to pull back, and you were saying that you felt we could either continue down towards, like 4,200, or that could have been the low that we ran up and out. Since then, we fell down a little bit further to 4,100, but then from there, we've essentially have been up and out. What are your thoughts on that move?
Yeah, that was what I call a perfect retrace. It actually was almost a very symmetrical inverted head and shoulder. So 4,100 actually made sense, but I didn't think we'd get quite down there, but we did. And then came right out of that. And I said, the week we turned, I said, it looks to me, after we had a couple very strong days out of that bottom, it looks to me, based on the fact that everybody's so bearish and the fact that the markets had 2 or 3 big days, I said, it looks like we're starting to melt up right now. I have been saying we'd probably really have to wait until, new highs, new all-time highs to really get the market going. But those first few days, there was just so much behind them that it felt like we were going to just come out of that last pullback and then just keep going. And that's really essentially what we've done. You can see the move, came right down to a trend line, bounced off it, and have moved right back up to that, almost to that 4,600 area that we started the correction from. So I don't believe we're going to see any more 8 to 10% corrections until we get to the top. You could have 3 to 5% corrections at any time. So, I'm not saying we can't, there's going to go straight up, but pretty close. I mean, I think we are looking at a steep rally. What a melt up means is something that's parabolic, ultimately parabolic, and very steep, and you cover an awful lot of ground in a matter of months. So that's what I think we're into now. Could we go back to 43, 4,400 before we take off to new highs? We could. Will we? I have no idea. I think a lot depends on what numbers come out that, trigger something. So let's say tomorrow, I think you get the PCE tomorrow, the inflation number that the Fed tends to watch. If that number is elevated, we've seen some signs here in the last couple of months that inflation's come back. If that number is elevated, it certainly could cause a couple 100-point sell-off in the S&P. If not, we may just off to the races, be off to the races. So it can go either way in the very short term. As a macro strategist, I'm not trying to call, the day-to-day, week-to-week. Sometimes I see setups like I did at 4,600 for that pullback down to 41,200. But generally, the story from here going forward is that we're in the melt up, I think, and that melt up is going to take us to 6,000 for sure. And I think there's very good odds that we're going to see 7,000 on the S&P. Maybe, I think likely in the first quarter. Doesn't have to happen in the first quarter, but I think that's the likelihood. And obviously, if we do that, you're talking about a better, something 50% or better appreciation from here. and in a matter of months. I mean, that's what I mean by historic melt up. It's going to be something we don't see very often.
So, looking at the catalysts, last time we spoke, you had mentioned a few things. You had mentioned oil contracting, dollar contracting, and then the rate environment looking to change. When we last spoke, there was still some semblance of another rate hike, even. Whereas now, if we look at the Fed watch tool, you just look at bond probabilities, you can see that essentially that's gone since the last time we spoke. It's the probability of a hike is minuscule. And again, we talked about this last time. You made a very clear note that Wall Street is thinking one thing, the Fed could be thinking something different. But right now, that's just what Wall Street is saying. So, how does that play into your view of the rate environment changing as a catalyst, where now we're even looking at potentially a rate contraction starting as early as spring of next year? Is that a key function still of this parabolic melt up, or is that a little bit too late based on the time frame you were just sharing?
Now, essentially, what you're getting, and I think I've talked about this for several months, is you're getting what I expected you'd get, which is you've gone from a headwind of Fed tightening and Powell reiterating at every meeting, higher for longer. And whether we hike more or whether we just stay at these elevated levels, that we're basically not done. You've gone from that headwind in just a matter of weeks to where the street feels pretty comfortable that the Fed is done. You're starting to get some, and this is new, some of the Fed officials coming out and actually saying we can even entertain a cut if certain things happen. That if inflation comes down to our levels, if the economy weakens, cuts aren't off the table at some point next year. So those are beginning signs that the Fed's starting to recognize that maybe they've done enough. Now, I've said they've done too much. I think when you're seeing the 10-year drop from 5% to today, I think got down to 4.25, and it's just above that now. To drop 75 basis points in a matter of a month, that is the street seeing that the economy stopped on a dime. I mean, you just got the revisions, 5.2% GDP in the third quarter, up from 4.9% in their previous estimate. So third quarter looks gangbusters, but basically almost like clockwork as the quarter ended, things fell off the table. And I think we may be in recession right now, as silly as that sounds, because you're starting from a strong quarter. It usually takes a while, but auto sales look pretty crummy. Housing sales look pretty crummy. There's real signs that we may have hit a brick wall on the economy. And, still the rhetoric out there is soft landing because, obviously looking at third quarter looks like things are not going into recession anytime soon. But I'm saying there is a good chance that what the market in the aggregate is picking up is that the economy is weakening pretty fast here, that we, and that's how recessions happen, is you can go from seemingly all okay to trouble in a hurry. I mean, I can remember in September of 2008, I was talking about a financial crisis, the likes of which we hadn't seen in the post-World War II era. And almost every Wall Street economist was saying soft landing, no recession in sight. Weeks later, we had Lehman, just 2 or 3 weeks after that, and then everything that came after that. Weeks after the economists, I mean weeks, not months, weeks after the economists were saying no recession in sight, we were in the worst financial crisis in the post-World War II era. So things can happen fast when they happen. And that's what I think the Fed's going to be surprised by. And that's where I think you run into the problems of having academic economists making judgments every month and thinking they can kind of, you read the tea leaves every month and make their judgments incrementally as they go along. this is how economies and financial systems happen, is everything seemingly is going okay until it's not. And I think we're very close to that point where it's not. Now, that doesn't mean we're going, because everybody knows I've got a global bust forecast for 2024. It doesn't mean we're going from, you know, seemingly decent economy to a bust with nothing in between. It just means the economy is going to slow down quite a bit here, and it's going to cause the Fed to recognize maybe something they don't even recognize today, recognize in the next month or two that they actually do have to reverse course here pretty fast. That is a trigger for a melt up. I mean, that's what I think the street's beginning to pick up on, or the market in the aggregate. The market in the aggregate is not the same as compiling, Wall Street strategist opinions. It's the market in the aggregate, which is law of large numbers. When you put everybody together, the market's a pretty good predictor of what's going on. It's not necessarily the same as what a consensus of economists or strategists are thinking. In fact, it's usually not the same. So I'm talking about the market in its ability to discount things is beginning to pick up that the economy is rolling over, the dollar's rolling over, rates are rolling over, and those are bullish things for the stock market in the next few months.
One of the things you brought up that I thought was curious was the GDP, which is why I pulled it up here. You were mentioning the possibility that we might be in a recession already. My question is, when you look at something like this, where we see in Q2 real GDP grew 2.1%, where's the idea of potentially being a recession fit in with actual realized GDP growth?
Well, I'm just looking at what you have up here. You said,
Sure.
what would you say for 2.1% for second quarter?
Yep, that it increased 2.1%.
Yeah, we're up to 5.2%. So, it's backward looking. You're measuring an economy quarter by quarter, looking backwards. And that's what I'm saying, is you can have things change. It typically isn't so convenient that it changes right at a quarter beginning or quarter end, but that seemingly is what's happening here, at least from kind of the anecdotal reports I'm getting. Autos are really slowing down quickly here. And a lot of that is because we just had this big bump in interest rates in the fall. So, we had, like I said, the 10 years fallen 75 basis points here, but in the few months previous to that, it had gone up 75 basis points. So you've had this, and mortgage rates went up to, 7 and almost 8%. So, you've had this big bump in rates, that is affecting the rate sensitive areas of the economy. And those happen to be big areas of the economy. It's impacting housing. Obviously, that's a big area, or construction. It's impacting autos. It used to be, we would say, as GM goes, so goes the economy. That's not necessarily true today, because GM's a smaller, less impactful company. But it is, as the auto industry goes, so goes the economy. Autos are still a big part of the economy. And if that's really changing here, in the next few months, you're going to see it's going to impact on GDP. So backward looking, the economy in the third quarter was strong. Forward looking, I don't think the next quarter is going to be so strong.
Got it. So talk to me a little bit more about how you view some of these different tools. Like you brought up automotive sales. I've definitely heard that before. Same thing with like home sales. We were just talking about GDP. How do you weight these different indicators to determine the prevalent direction? Because as you said, if we do look at something like GDP, that's been expanding, although it's, previous looking. If you look at something like auto sales, it's also previous looking, but to your point, you're seeing that that's contracting. How do you fit all these together to then make your assessment?
Yeah, it's not very scientific, because I am certainly not the quantitative type that believes that the market fits in with that. So in other words, the market is discounting things many, many months in advance. So I don't really care what fourth quarter GDP is, whether it comes in negative or positive. I'm just saying that you're seeing a net change at the margin, second derivative change in terms of the rate of change in the economy, in some of the important components of the economy. You're also seeing it in the credit card delinquencies, and you're seeing it in the consumer pulling back on large purchases, the more capital goods intensive purchases. So in the summer they used, they pulled back on consumption so they could, or of goods, so they could do travel. Now they're going back the other way, and I suspect Christmas will be okay, but other things may not be as strong, like durable goods, because they have limited ability to spend. They can't spend across the board, so they have to kind of pick and choose. They're still shop till you drop. They still want to spend, but they have to be more selective about their spending.
This is honestly worse than I thought. I hadn't looked at this in a little while. This is delinquency rates on credit card loans for commercial banks, commercial banks, excuse me. This is, I didn't expect it to be quite this steep. What do you make of this? Like, I definitely thought it would be expanding, but I didn't realize it would be expanding quite to this degree.
Yeah, no, it's basically, I think we're at delinquency rates that are worse than 2008-9. So what you're seeing is the problem of a have and have not economy. We've talked about this before. The top 10% of the wealth has plenty of money, and it feels no problem. The market's not that far off highs, and real estate's up up through the roof. So those guys feel pretty good. But those at the bottom probably 20 or 30% are sucking wind. I mean, and we started talking about this many months ago. They were using their credit cards to pay for groceries because their budgets couldn't withstand the inflation they were seeing at the grocery store. So those that really have limited incomes are struggling mightily already. You did have obviously the whole influx of money that came from the government during the pandemic, and that's being drawn down. So that's where you're beginning to see the friction also, and why this thing can stop on a dime is, I think you're reaching the point where a lot of that money that was pumped in from the government and boosted savings up to a 35% savings rate at one point, unheard of. That's all. A lot of that's been drawn down. It's allowed this thing to stretch out. It's allowed the cycle to continue longer than I thought it would, longer than most economists thought it would. But I think we're reaching the end of that, and delinquencies are a sign. And one of the reasons why I think as we get into 2024, we ultimately go into a bust, because there's debt everywhere. I mean, the consumer indebtedness is problematic. Sovereign debt is problematic. Corporate debt, a lot of corporations are in pretty good shape, but there's obviously those at the lesser rating end of the spectrum that are very leveraged. So, I think consumer delinquencies or credit card delinquencies is just another sign that we are moving towards something that's not going to be pretty. And I think soft landing is a pipe dream.
It's curious because, like you were highlighting, we're maybe halfway to where we saw the peak, a little less so than during 2008, 2009 in terms of delinquencies. But the part that I find interesting is this all took place, obviously, during a very rapid contraction in economic functions during a just massive economic collapse. Whereas this has been on a bit of a smooth scale slope up at a decent clip, supposedly during a time frame where we're not in a recession yet.
Yeah, so in other words, if you were to compare, you'd want to compare the period in 2006-7 going into 2008.
Right.
And it's what will come probably in the next year where you're going to see it surpass 2008-9. So yeah, I mean, we haven't even gotten to the recession yet. That's, as you correctly point out, that's where this thing can go pretty vertical.
Interesting. And then the other thing you highlighted that I wanted to grab, this is from the Bureau of Transportation Statistics just on car sales. And it really highlights a couple interesting things that I wanted to get your take on. So the first one is the production, which is this red line. Production is cratered. This is production, thousands of vehicles is on the y-axis. And then the x-axis is just the year, where production has gone from over 4,000 units down to sub 2. And it was at 4,000 units in 2015. And this is just cratered. And then as we look at like sold passenger vehicles, exactly as you were talking about, that's contracted massively. So how do these two things weight against one another? Or is it more of you use them in conjunction with one another, things like automotive sales and then delinquencies?
Yeah, I mean, I'm not an auto analyst, so I don't really look at this in detail. But what I'd say is, obviously, we had the supply chain issues for a while there, so that was some of the production issues. And then, I'm not sure whether the strike probably had something to do with some of the supply issues now or production cuts, but looking at this, I would guess inventories. Let's see, my eyes are not too good here, but
the red is commercial passenger vehicle inventory, essentially the production.
Yeah, so looking at this, inventories would seemingly be in good shape. The problem is, I think, demand. I mean, it's the same story I've been telling about oil. You can sit and focus on supply, but if demand's going to fall off, there's going to be an inventory build. And I think the auto companies this time around have another issue as well, which is they decided in their infinite wisdom that they knew best what the market wanted, and they jumped whole hog into electric vehicles. And the market's saying we're not really that interested in electric vehicles. Hybrids maybe, but not electric vehicles. So you've got a mixed problem. You've got a lot of capital expenditures going into the companies transforming themselves for what they think is going to be a big EV future, and then you've got a recession about to smack them down. So I think certainly the auto manufacturers that have made the big bets, meaning Ford and GM, may be in for a real tough time in 2024.
You mentioned oil before, so I grabbed just crude oil here. This is a 1-year chart. It's definitely contracted quite a bit. When you and I spoke last time, you had talked about potentially oil getting down into the 60s. And for reference, when we spoke again, it was in August. So it was kind of in this time frame here.
Yep.
So we pulled back down into the low 70s. Do you continue to see oil contracting further from here?
Yeah, absolutely. I took a lot of grief up at 90. We were close to 95, I think, at that high point this fall, a couple months ago. And I had people coming out of the woodwork saying, "You're wrong," even though I had called the move down to 60 initially, or down to the mid 60s initially, and then said it'd probably be in a trading range between 65 and 85. When it broke above 85, went to 95, and everybody was saying it was a layup to 100 and 120. They were just so sure I was way off on my call. That proved to be the high water mark, and it's been downhill ever since, and downhill pretty hard and fast. So yeah, we're in mid 70s. I think we go down to low 60s, maybe 60, and then bounce maybe back into the 70s before we head for 30. So I'm still very much a bear on oil. The story is still very much demand driven by a global recession and a global bust. So and it's funny when you look this fall, one after another portfolio manager or analyst would come out on CNBC and elsewhere promoting energy as one of the attractive areas to own because they still thought it was a good value and that oil prices were going to head higher because demand was tight. I mean, supply demand was tight. And the truth is, it's been the exact opposite. So, and I think there's a lot of risk in the energy sector in terms of the stocks. So, I'm very much at odds with what I think most portfolio managers were saying just a couple months ago. I don't know if they're changing their tune, but certainly the tape is negative.
Yeah, as a trader, this isn't something I would be buying here. Maybe as a long-term investor, if you're super bullish, perhaps. But when I look across the performance of sectors across multiple timeframes, and this is XLE for anybody wondering, this is the energy sector for the S&P 500. It's essentially, this is a 1-year daily chart, and it's, for all intents and purposes, flat. And definitely since the fall, it's been in a pretty significant drop from a high of 93 down to 83. Yeah, this doesn't look healthy to me, at least for a bullish thesis. This would be decent for a bearish thesis, though, I think.
Yeah, well, I have a target on XLE in the bust, so not now, but sometime next year. In the bust, I expect XLE to get down to 20 or below. So where are you, 85?
Yeah, right now it's 83.
Yeah, 83. So I mean that's a pretty good hit, although I'm calling for an 80% peak to trough drop in the S&P too. So it probably fits right in.
Yeah, because just for a reference period, I zoomed out quite a bit, and it looks like the last time it traded in the low 20s was during COVID.
Right.
Yeah, it hasn't been down there since.
Yeah, it was really that drop when oil went, the futures went below zero. You had a couple of days there where oil was trading in negative territory, if you remember, back in 2020. And so it took XLE down there too. If you broaden this chart out to a 20 or 30-year chart, you'll see a massive head and shoulder. Some people don't believe in those, but in terms of something that long, but you can see the shoulder way over on the left side there. Yep, a head and then another shoulder. So that counts down to 20, in my opinion.
That's really interesting to see kind of a head and shoulder pattern on something this long. So
Yep.
when we're thinking about both first the melt up and then the bust, let's talk about the melt up. What's the structure of it within the sector breakdowns? Like what sectors do you see leading this melt up? And then how does that in turn behave on the bust on the 2024?
Sure. I think the leading sectors, by the way, I expect it to be a broad rally. So a lot of the laggards are going to catch up. I think the Russell, the small cap, are going to have their day in the sun. There's been a lot of skepticism about that because it's been slow getting started, but they're basically up 10% off their bottom of the last month and beginning to catch up. I think, I have a target on the Russell 2000 of 3,000. So that'd be probably a better move than the S&P, but so small cap will play, large cap will play. I think semiconductors are going to be one of the big areas continuing their strength. They've made new all-time highs. I mean, that's something nobody saw. I was calling for it, but nobody else. I have a target on SMH of 300. So that's basically almost a double from here. It's 160, I think, 162. So almost a double, and it could double from here. So, that's a leader. I think the miners which are just waking up, are going to be outperformers. Industrial stocks are not far off their highs. They're going to do well. I think the commodity stocks will do pretty well. But also, I think there's big catch-up rally in financials. As rates come down, I think you're going to see a big rally in the financials. The stockbrokers to me, are probably going to do very well. If you have a 50% move in the stock market or better over 3 or 4 months, you can bet that the brokers are going to do very well. Maybe, I don't know if they'll double, but they'll be up there, certainly well over 50%. And the things that so it's cross board. I think you'll get some consumer discretionary. I think will play. Housing will continue. The home builders will continue to play, even though housing has peaked and is rolling over. The dynamic out there of home builders being able to subsidize rates or offer, buy down their interest rate and have enough margin still left over to make money on their houses because housing prices are up pretty good. That will allow home builders, the home builder group, to continue to perform here. So it's really an eclectic group of leaders where you'll probably see some lag. Doesn't mean they will go down, but I suspect that the defensive areas will continue to lag. Healthcare has been lagging. Consumer staples has been lagging. Oil, obviously, energy's been lagging, and utilities. Even though utilities will get the benefit of rates continue to come down, they can't give you the upside that you can get in some of these other sectors.
Interesting. So then my next question, looking out at the bust, is it kind of same where it's going to be across the board? Everybody is falling off a cliff here. Or do you think that there will be some that are accelerating more so to the downside than others?
Yeah, I think it's probably going to be pretty all inclusive. As I say, the two assets, I'll talk about the stock market, but the two assets that probably will hold up, that I expect to hold up in the bust, and meaning they probably won't lose money. They may make money, and very much should make money, would be treasury bonds and the whole treasury sector, because it's government guaranteed and rates will be coming down sharply. And then cash. I mean, those, and the dollar, probably, if somebody's looking at currencies, the dollar should, not from here, because I have a big call on the downside dollar here, but from that bottom, the dollar during the bust should do well. So those are the only things I see basically fighting the downtrend. Everything else across the board, the stock market, as I said, I expect something close to an 80% drop, peak to trough. That to get that, it's pretty much across the board. Everything's going to fall pretty hard. Energy will, industrials will, anything cyclical is going to get hit hard. Housing, home builders will get hit hard. Semiconductors will be hit hard. So a lot of the things that will play here in the melt up will do a complete reversal in the bust or in the bear market. So this isn't, again, I don't provide advice. I'm not necessarily telling people how to play this. I'm definitely not telling them how to play it. Everybody has to make that decision based on their ability to be nimble, their ability to accept risk. Because I could be wrong. I mean, to call something this dramatic and to say it's going to happen in the next several months, if it doesn't happen and you're all in on it, you have to know the risk you're taking. So it's really important for people not to just kind of go in as if, well, I play the market when it goes up and I get out when it goes. It's not that easy, as you know. So people have to understand the risks they're taking when they're doing it, and understand that while there may be big, this is what makes it such a conundrum. There may be some of the biggest returns just ahead that we've seen certainly in my 50-year career. Some of the biggest returns available at this in a short time, but they'll be evaporating away just as quickly. So yes, great returns, but also great risk. Risk that you get out too late and you're caught in this huge sell-off. Because I think a lot of this on the way up and on the way down is going to be steep.
Now, For the melt up, you shared some pretty specific criteria that you were looking for, kind of some specific catalysts, I should say. What does that look like for the bust? What are the specific catalysts that then rotate us over from this parabolic melt up?
Yeah, so I don't know if I'd call them catalysts, but certainly what I think gets us a bust. And I have to make sure people understand that when I say bust, I'm referring to the economy and the overall financial system, um, as opposed to bear market is specific to the stock market, obviously. So bust, people say bust and they're referring to what they really mean is the bear market. Um, so bust, when I'm referring to the economy and the financial system, it's caused by the fact that we have more leverage on the system. And again, it's a global bust. So more global leverage on the system, or more leverage on the global system than we've ever had by a large margin. I mean, we are so much more leveraged than we were in 2008-9. Levered, the banks are levered, not ours so much. Ours are in better shape, but banks around the world are very levered. The sovereign debt is through the roof. And you can say, well, the government has printing press, or the central banks have a printing press, so sovereign debt's not at risk. Well, I would say it's probably true here. I don't think it's at risk in most of the world, but you never know. We've certainly seen sovereign debt go under before. And so I use a simple kind of equation to just define what I am seeing, and that is when you add the fragility that the pandemic caused, even though it's a few years behind us now, it still has led to a lot of fragility in the system. We were talking about the savings that got built up, government aid, and all of that that's being wound down. The fact that we had a moratorium on student debt and that's come back. Those are all things that it's not a smooth ride. It's like all of a sudden they get surprised that they weren't counting on having to pay back debt and now they have to again. So there's fragility in the system, what I call a massive leverage. As I say, it's 300 and some odd trillion in debt across the globe now. And then plus what I call a huge central bank policy error. It's a Fed policy error, but it's also happening in the ECB and Bank of Canada, Australia. I'm sure China's making their problem, their economy's evaporating. So you're seeing what I think is over tightening, because central banks are saying we're going to tighten until we see the results of our tightening. By then, because of lags that are typically 6 to 9 months or maybe even a year, you end up by definition being many, many months too late in recognizing that you went too far when you finally realize it. And that's what I think when I was talking early in our interview about maybe hitting a brick wall. It may be not, I'm not saying December or even January, but it may be within a few months that we find out that, the Fed finds out that they did go way too far, and things start happening fast. We're starting to see signs that the banking systems, lending is dropping fast. The bank loans, you're seeing that drop. You're seeing, the reverse repo. That's come down a lot. That's a sign, I think, of the banks wanting that liquidity. So there's something going on out there that suggests that we're getting close to an inflection point between an economy that seemingly was okay and people are talking about soft landing, and maybe 2 or 3 months from now we're going to be talking about a hard landing and ultimately a very hard landing.
So you're referencing the leverage and then liquidity. Are you hinting at some sort of credit contraction here that then leads to a rapid acceleration of the bust?
Ultimately, I think that comes about. I mean, think of 2008-9. it will happen differently this time, but that's basically, that's what happened. It became a domino effect. I don't know whether it's mid-year next year or sooner, but that's kind of what I'd say is likely the time frame for, sometime second quarter, let's say. And it might be late second quarter, it might be earlier, but where I think you could start seeing the results of central banks having way over tightened. And so, yes, you could have bank failures, certainly credit spreads widening. None of that is showing up yet, by the way. I mean, the credit spreads are narrow. So that's why I don't want people jumping on this and saying, well, it could be next week or it could be next month. We're not, we'll get some more. I'm picking on things, seeing things that are kind of precursors to the precursors. So, there's still time before that happens, and that's why you can have a meltdown. But there are danger signs out there that are suggesting that we're moving in that direction, and that ultimately, what I mean by a global bust is as I say, 2008-9, we came close to a global bust. It was when GE was rumored to be unable to access the commercial paper market, and they were so dependent on the commercial paper market that there were rumors that they weren't going to make it. This was when Citibank was selling it a couple bucks, and the money center banks were all in trouble. And then all of a sudden, GE looks like they may go under, and it's one of our blue chips. And if the Fed and the government had not acted very quickly to assure the commercial paper market stayed open and liquid, we could have seen the bust then. So a bust will be going that next step beyond 2008-9, where I think the financial system can go into free fall. And like I said, I'm not so worried about U.S. banks. We're better, there's counterparty risks, so you can never say that it can't happen, even though they're better capitalized this time. If the European banks start going under, they can take ours, and we can have real trouble too. So, I think more of the risks are overseas this time in the banking system. But we saw in March there's plenty of vulnerability in the regional banks, and we also saw how fast banks can become illiquid, right? I mean, the money starts flowing out of those regional banks as people get nervous, and all of a sudden those banks go under, or several. You started seeing a domino effect there. So I do think that we could see a free falling financial system, which is why I continue to say this will be the worst financial crisis in certainly the post World War II era, meaning worse than 2008-9, and could be the worst in history because of the size of it.
If you were to steelman your argument and to think of an alternate scenario on how this could play out differently, what would that look like?
Well, I could be wrong in terms of the magnitude of, I do think we're going beyond a soft landing, but I could be wrong that it gets to a point of an extreme hard landing and we start seeing this financial crisis overseas that then spills over into the whole globe. It might not get that bad, and therefore it might not require the kind of central bank response I'm talking about for the other side. But I'm pretty comfortable with my forecast. I think, the likelihood is it's going to be a harder landing than 2008-9.
Right. Yeah. The reason why I like exploring that side is just to see what alternate path, what alternate trajectory things could go. So I think thinking through, especially something quite so parabolic, is just an interesting thought exercise for me. You mentioned a little bit earlier about the financial system, and what I was picking up was just financial stress, right, on the entire system across the board. Is this the kind of thing that you think literally can break the existing financial system? And if so, what happens in that scenario?
Yeah, here I say I differ from the Peter Schiffs of the world out there who basically are saying we're going to see a break of the system. I think, or those in the Austrian school that think we're getting this kind of cleansing of the system. It really breaks, and then you start over with a much better system. I differ from believing that this is that break because the central banks, this bust that I'm calling for is going to be a deflationary bust because we're heading towards 2% inflation now. If you get the break, I think you're going to get in the global economy, you'll quickly go into deflation. If you go into deflation, that gives central banks around the world almost infinite ability to print money because the lag to when that deflation then turns in or that money turns into inflation again will be a couple of years. If you're in deflation, you're not going to be back in inflation or high inflation a year later. It's going to be a couple of years. So that means they're going to be focused on saving the system, right? If it's right in front of them, you've got two things you're looking at. One is right in front of me is an economy that's collapsing, a financial system is collapsing. But I know that if I print too much money a couple of years from now, there's a risk that might cause inflation. What do you think they're going to be focused on? They're going to be focused on the collapsing system. So that means they will print as much money as they have to stabilize the system. My argument is it took 5 trillion to do it back in 2020. I think this is magnitudes of that. So I think we're looking at a 20 trillion expansion of the Fed balance sheet this time. That's 4 times that, and something proportional to that around the world. So it's that massive printing of money or pumping of liquidity into the system that will stop the free fall. But it doesn't happen immediately, and they're not going to go right from, they're not going to say, okay, let's throw 20 trillion in there because I know that's what we need. They're at this point they'd say that's never going to happen. You're never going to see. You're not even going to see 5 trillion again. In fact, they're telling us they don't want to do QE ever again, or ever see that kind of thing again. So that's part of the reason why we're going to have a bust is because they're so reluctant to repeat the mistake of 2020 again, right? And frankly, the mistake of the last 20 years of being the Fed put. So if they really believe that their job is to get the balance sheet back to normal, and normal being pre-2020, they actually, and I've seen them say this, they actually believe they can get the balance sheet back to 3 or 4 trillion from 9, that they could take that 5 trillion back. That's a real problem. I mean, because there's no way that can happen. They're down $1 trillion or a little more now, and they're already, I think, have gone too far. But not to jump around, but I do think that the magnitude of the free fall means they'll start reluctantly putting in, trillion, 2 trillion, whatever, and it will do nothing to stop anything. So they pour in a few more trillion, it does nothing to stop anything, or maybe stop something for a week or two, and then trouble comes again. Ultimately, this thing just, if you have the global financial system imploding, it takes a lot to stop that. And they're not going to know what a lot is until after the fact. I mean, they're only going to know with a lag to what they do, and they're going to just keep pumping money every time they see more crisis coming at them. So it's gonna play out over many months, not over a few weeks. But there'll be chunks of money coming in week by week, month by month. Ultimately, when you look back, this is a total seat of the pants guess, but I'm guessing you'll see something close to a $30 trillion Fed balance sheet. And that $30 trillion Fed balance sheet, or the additional 20 trillion, will probably be pretty close to matched by the amount of new debt coming out of the government, meaning they're going to come up with every new program they can to stimulate things. Okay, pension funds are failing. We're gonna put through another bill uh, we need $4 trillion to support the pension fund problem, so that nobody loses out on their pension. Um, we're going to need endowments are failing. Well, we don't want that. That means we're going to see all these colleges fail. We're going to support the endowments. You're going to see money coming out of everywhere. I mean, coming out of the government for everywhere. And there's probably going to be universal income. There's probably going to be all kinds of programs that I think are going to only exacerbate the problem down the road. You're going to create another problem. But while you're in the midst of this crisis, they're not going to stop. I mean, they're not going to think long term at all. They're going to be only thinking about how do we get ourselves out of this crisis.
Kind of heavy thought.
Yeah, well, that's why I think we go from, I mean, it sounds crazy, and I keep saying we're at the end of an 80 or 90-year super cycle, between two depressions. And that's why we can go from, what I think is a melt up this year to an 80% down next year to an inflation cycle like we've never seen before, where we see 25% inflation rates by the end of the decade, and then a collapse of the system in the 2030s, because you're dealing with everything in terms of what's right before you, without any thought to what you're creating beyond that. So by the time you realize you've over tightened here, you create the opposite problem where you're going to have to over ease. Then you create this huge, and because of leverage, it's not over easing by a little bit, it's over easing by tens of trillions. By the time you realize that created an inflation problem, you're well into an overheating that you can't stop. And then what do you do? And obviously we'll have to service our debt, which I don't know how you do that when rates are roaring away. So you're getting into that place where the elastic band gets stretched, and then it's like a bungee cord. It gets stretched and stretched the other way, and the waves get much bigger.
Yeah. Well, one of the things I am hopeful for is that when we're going through this process of, passing a lot of these different bills and whatnot to potentially try to keep the lights on, maybe we could finally get the daylight savings bill through as well, so that it doesn't keep getting dark at fucking 4:30. That would be okay. That would ease the pain a little bit.
Yeah, I don't understand, who gets their back up over something like that. You'd think that would be one thing that you could get both parties and all
Yeah.
sides to agree on, and yet even that they can't solve.
That was the joke I ran for a while. I said, we're in trouble when like you can't even unify behind something that everybody universally hates.
Yep.
So before we wrap up, you talked a little bit about some of the commodities, right? So we talked about some gold. We didn't talk too much about metals. So how do metals behave during this cycle?
Yeah, I'm glad you asked, because I think metals are just coming alive. It's been a long wait. They had a great run from the March lows in 2020 to the August highs, particularly silver, but silver and gold both. They went sideways to down, and probably more down than sideways, from August 2020 to just a little while ago. And we are coming out of that now. Gold's performed better than silver, so gold's not very far off its all-time highs, and I think you're going to be there probably this year. I think could be there in a couple of weeks, but whereas silver's got a longer way to go. I mean, the old high I think was up near 50 or 48, somewhere up there. I think silver can get to 60, but it's going to be a longer slog or a steeper slog to get there. But you can see you had that sell off. I presume that trough is 2020. Is that where we are?
Yeah. So this is actually a year ago. So let me zoom out a little bit more to get closer to your thesis. Yeah. Okay. So on this one, 2021 is back here. If you want 2020, we can go 5 years. So here's 2020 back here.
Yeah, so you see, you had that quick sell-off in March 2020, then you had the big run-up. And then you can see it's been basically a sideways down consolidation pattern. When you're in it, and because I've heard this from plenty of people on Twitter, when you're in it, it feels like it's been god awful. It's been is just straight down. But if you look at it from a 5-year chart, it's a consolidation. It's just a long square root pattern, or cup and handle, whatever you want to call it. And we're going to come out of that long, almost 4-year consolidation, 3.5-year consolidation. We're going to come out of that vertically and head, I think, to 60 and maybe even to 75 before the bust. So that means, I'm basically thinking, and I can be off by months, many months, but I'm thinking there's a decent chance that we come out of this and see silver at somewhere between 60 and 75 by the middle of the year. And same thing, gold. I think you bust out above 2100, or 2070, wherever the 2080, wherever the high was. You're almost there. You bust above that, and you're going to have run to 3,000 very quickly. So again, within the next 6-7 months, and then you correct in the bust with most assets. I'm not sure if you correct back to here. Silver probably does correct back a longer, it's going to be it's a more cyclical metal, so it'll get hit harder. Gold might hold up a little better because of its safety features, or it's, in a crisis. Some people might run to it, but I still think it probably goes from 3,000 back towards 2,000. And then once you get, well into the bust, and these assets start anticipating the next cycle, I think gold goes to 20,000, silver goes to 500. You're going to have a big run. So there's a big run directly ahead, then a big correction, and then a huge run between, let's say, 2025 and 2030. So I think the metals, you can see what they did. If you take a long chart and look back, they had great runs in the first part of this decade, or first part of this century. 2001 to 2011 was a huge run. 2016 was a big run. What I see here looks a lot like 2016, particularly in the miners, looks a lot like 2016 and 2020, those runs. So, you've got some very fast vertical runs, I think, coming. They got to work through, particularly the miners have to work through a lot of overhead resistance. So it's hard to tell exactly when they'll run and when they'll correct, in a stair-step fashion. But I think we're going to find, as people start warming up to them, this is a pretty thin group. There's not a lot of liquidity in those stocks, so that once some of the institutions start seeing the momentum and decide they want to allocate to gold, silver, and the miners, I think you could see very thin markets, where you get a lot of price movement in a hurry. In terms of other metals, I'm bullish copper. I think copper is probably going to get up to $6 pre-bust. That's a pretty big run, since we're in the 370 area, I think, or maybe lower. And I think the copper producers are going to do pretty well in that period too. So, and other metals, steel to me looks like a big performer. I didn't mention them before when I was talking, industries that'll do well, but I think steel industry, which has been flat on its back for many years, looks to me to have great potential in the melt up. So you could get pretty big move there. Iron ore obviously would be similar. Some of the other industrial metals, I think, can play. So that may seem counterintuitive, because I'm talking about an economy that's going into recession. I think what happens in this melt up is people will choose to, first of all, they're not going to see the hard landing that I'm calling for. They're going to be seeing soft landing. And I think they're going to be willing to look over the trough, because the Fed is done tightening. And if the Fed actually eases, they're definitely going to look over the trough, I think. So I know this is kind of a caveat. I know there's a lot of people that have seen the chart that says when the Fed starts cutting, that's when the stock market does worse, right? So, and I've said I'm not even calling for cuts now. The cuts could come in the bust, and that I'm just saying pause means end of tightening, and that will be received initially very bullishly. But I just caution people from buying too much into a narrative that is driven by, some chart that says every time the Fed cuts rates, that's the top in the stock market. I don't think it's going to work like clockwork necessarily. I do, obviously I do have a bearish view. It's just not before we have this run.
Right. Well, and as you've pointed out before, right, things change. And as new information comes out, things do change. And it's always interesting to see how you piece all of these different moving things together into your thesis. I am very curious to see how the boom and bust thesis kind of plays out, because it definitely has been a long time coming. I know from you and I, when we first started talking, you'd been envisioning this for some time. So hearing you talk about the melt up being underway is really intriguing to me. So I'm excited to see how it all plays out. For me, as a trader, my life is simple. I trade very short-term time frames. So whatever happens, couldn't care less. My job is to capture smaller movements, but I get to enjoy the ride, which is pretty cool. But
sure. Yep.
I mean, you've shared a ton of awesome information. Thank you so much for taking some time to hang out. I really enjoy doing these with you. So looking forward to catching up with you again. But before we sign off, as per always, where can people get a hold of you?
I'm sure. I'm on Twitter, so it's Dave H. Contrarian or at Dave H. Contrarian. I'm on there most days, doing battle with everybody. It's a little easier these days because the market's going in my favor, but as you well know, I've had plenty of critics along the way. So it's the plight of a contrarian, if you're, and particularly one that's an extreme contrarian as I am, that people are going to think you're nuts because you are the only one saying something, But as the market moves in my direction, people come my way. It doesn't look quite so crazy. So I'm there, enjoying myself, and I also write a investment letter that comes out quarterly. If it's by subscription, meaning there's a fee to it. If people are interested in it, they can direct message me on Twitter, and I will provide details.
Awesome. And I'll make sure I'll throw a link to that in the notes below as well, so that they could easily find you. But until we have a chance to connect next time, David, thanks for hanging out for a bit.
Yeah, great to see you, Eric. We probably won't talk to each other before Christmas, so Merry Christmas to you.
And Happy New Year. You always got to get that out of the way too. Yeah, we'll probably catch up in the spring sometime.
Yep, sure.
Awesome. Well, thank you, David. Take care.